Greetings everyone. In this video we're going to discuss how the gold futures respond to the Nasdaq, the S&P 500, and the Russell 2000. Stick around. Okay, this is going to be a quick little video here showing the differences of the convergence and divergence of gold versus the indices. What we're looking at here is the Nasdaq, or the NQ futures, which is follows the Nasdaq 100, and I'm on a 1-hour chart. Now, full disclosure, I did go back a little in time, and we're looking at January 5th into January 6th to be sure that I found a really good area that shows what I'm going to explain here. Well, here's the Nasdaq, and let's add on the ES, which is the S&P 500 index, and we can see that right away we have some similar movements. These are breaking down, a quick little drop, build back up again, this little camel hump, and then back off to parallel channel here. So we're going to add in the Russell 2000 now, and the Russell 2000 is the small cap stock, so in the stocks with low market cap. But you can see that it does follow the same process. I mean, this is a pretty good drop right here. They level off, and this is this camel hump that I'm talking about. Now, gold, when you have these movements, the gold futures tend to run opposite these movements. It's when prices are going up, the interest in gold is going down, and when the markets are going down, the interest in gold futures goes up. We have more investments. It's a more stable, longer-term investment. So we see this quite often when we have these divergences or convergences coming together. Let's throw gold on and take a look. Here's the gold. All right. It's pretty clear that what we're looking at here, if I throw just eyeball a channel on this, touch the bottom and the top, it's pretty clear that these three indices have an uptrend going on, and this little bump going up and back down again. And then we take a look at gold, and it is pretty much doing the opposite in this same time frame. And that's really something to take a look at. Now, would we see this at the start, or will we know this is going to happen? Probably not. But once it does happen, and we come over to this side, and we can see that right here, they start to level off, and it levels off here as well. We can look, potentially place an order here for a buy, for it to run back up when these fall back down, or one or the other. If the indices come down and meet the gold, or if there's more interest in gold once things level out and goes back up again, or they both come together. So that's something you want to look for. Long on one, short on the others, get the convergence going. And it's also the opposite. Once they come together and converge, you'll want to look in long the indices and short gold, and you will get the spread going the other direction. So one more thing I want to add into gold. Okay, let me clear all of these drawings off here. We're going to add one more a ticker on this here, one more instrument, and that is silver. Silver and gold. Look at what they do. They are very, very, very similar. Now there is generally a slight lag because there is a formula, there's a pattern that goes along with this that I'll probably put in another video. But this is really something I wanted to show you. You can go short on gold and silver when the three indices go up, long on those. Here's your divergence, back to level. Go short on these, long on this, get the convergence back again. It's something to consider. It's particularly not my particular style of trading, but this is definitely for longer term investments, swing trading over a few days or over a week, and so on. So take a look at that, give it a shot, let us know what you think in the comments below, and we'll see you in the next video.